talked about the rules of the road. I think everybody's seen these things about 7,432 times. Basically, no one in these in our meetings are offering any trading or investing recommendations. Everything we do is for education. They're just ideas. Any trades that are put forward are paper, and everybody understands that they're responsible for their own trades, and that trading is, or you can lose money trading, so you are responsible for that.
So, said another way, we're all big boys and girls. We take responsibility for what we do.
And we don't cry after.
Well, sometimes we do.
Okay.
Okay. Today we're going to go into some basics of the strategy. All right. At any time, if anybody has any questions, speak up, type in the chat. I'll be trying to watch the chat box as I go. And let's go. Can you hear me okay, first of all? Good, good, good. Okay. See, so I'm going to start with the most important rules again. These are very important, I believe, because you need to understand what it is you're trading. I just really can't emphasize that enough. Let me do something real quick here. There we go. Okay. So our 4 rules, again, start by paper trading. This applies to everything, and I'm going to describe number 4 in just a minute. Start by paper trading, then move to small positions. If you're happy with the results of your small positions, then move to full size. If at any time it stops working the way you expect it to, stop and go back. Something has changed. That's exactly what happened to me this week, not last week, but the week before. If you're paper trading this along with me, you would have seen that your options buying power would have fallen below 0, meaning it was a negative number. And what that means is you would have had a maintenance call. And what a maintenance call is and this is one of the reasons I want to get someone in to talk a little bit in detail about margin. What that means is when you trade a synthetic, of course, is has the two option sides, the call and the put. The put side requires that you maintain a certain amount of equity in your account. As that requirement changes depending on the price of the underlying. So as the market went through a pullback, you would have noticed that your option buying power fell to below 0, which means that you would have had a maintenance call. So I've tried to research this and find out why that happened. And as it turns out, originally TOS, calculated your margin requirements a little bit differently. So where if we put on a short synthetic in November, we were covered against a long synthetic in, say, September, March, July, June, whatever month. The way TOS handled it is it basically looked at your overall delta. Well, that was not the correct way to do it. It was the way that TOS did it. And so as TD Ameritrade didn't change their rules, what they did is they basically fixed it so they're applying the rules. So, like I said, this took a few online chats, web searches, a call to the trade desk, and another call to the margin desk to really make sure I understood what was happening. And it affected the way that we're going to talk about putting on protective strategies, not in a bad way, just a different way. So the bottom line is, if you have a typical margin account, which they call a regulation T account, your long option has to be in the same month or a later month than your short option. So effectively, the way it was explained to me is the long put in November, because it was shorter or a shorter time than the long put in, say, December. It was not viewed as a hedge against that. I'm sorry, short put in December. It was not viewed as a hedge against that. So even though the delta was effectively zero, just the timing of the two, that's not the way they considered it. So as the market pulled back, the margin requirements increased, and that was the end result. So as it turns out, it doesn't really affect us too much. It just changes the dates that we're going to pick for when we put on protective trades. So I went through our paper account, and I did a couple things here. First of all, most of our margin was coming from a synthetic that we had that expired in June, and that was synthetic is a long call and a short put. Well, what I did was I closed the short put. That was step one in going through and making these adjustments. And I kept the long call because honestly, I'm still bullish long term, and I expect the value of that long call to go back up. And at some point, I will be adding a short put to it to make that a synthetic position again. Now, we also had two short synthetics in November, which was the two long puts and the two short calls. I ended up keeping those synthetics, just even though they weren't acting as a hedge under the rules, they were still very profitable. As a matter of fact, the short calls fell down to, I think it was 50 cents, well above the 80% profit mark. I think it was closer to the 85 or 90%. So I ended up closing those short calls eventually, but still have the long puts in place. And obviously, as you might imagine, the long puts are doing very well right now. So those are basically considered a separate trade as far as all of this goes. So what I did do to put the protection that I thought I had on in place is I went to March and sold. These were roughly at the money. I sold 3 short synthetics there, and I wanted to show you here where the hedges are. So as you can see, one of those short calls is hedged by this further out long call. This short put is hedged by that long put. That short call is hedged by that long call. This short put is hedged by that long put. And that long call hedges that short call. And then lastly, this short put is hedged by that long put. So as you can see, it was just a matter of moving positions that were originally set in November, but just moving them out a few months so that they provided that same level of protection. So overall, our paper account right now is roughly delta neutral. However, only 3 of our synthetics are hedged under the Regulation T rules. So that's a lot of information. And like I say, it took me several calls and a lot of research to figure out. But so I'm just going to ask you simply, does that make sense to you? Do you have any questions before I go on? Or have I just baffled everybody and you have no idea what I'm talking about? Or is this so basic that everybody else is going, of course, I knew that. Maybe I'm the guy who didn't know everything, who thought I knew it and didn't. No questions, no comments? Baffled, but I'm just starting confusing. It was confusing. So, and that's actually why I wanted to put this in there. Yeah, the recording will be shared shortly. Basically, what it comes down to is if it just comes down to time. You're just the basic rule is your long option must be in the same month or later than your short option for it to be considered a hedge. So it's a little bit different than the way TOS used to calculate it. And but as it is, it turns out that TOS was not calculating it properly. They just fixed it. So Rule 4 did kick in. I followed those rules, made sure I had the right answer, and went through there. Will I rewrite the plan? Yeah, I do need to make some updates to the plan. I'll get around to that sooner or later. But it is exactly how I'm going to present it. Let's see, with Reg T, it may not be appropriate for an IRA. Yeah, an IRA is typically not a marginable account. You have to be cash covered as a rule. I'm not sure where there might be differences to that, but as a general rule, IRA trades are cash covered. Okay, so before we go on to the strategy, I want to do a quick review just to see where everyone is as far as the subjects that we covered last week. And this will kind of give me a feel for anything that I need to put more emphasis on, or if we need to go deeper into. So I'm going to start out with a couple of questions, and I'm going to watch the chat box for answers. And so let's start with the first one. There's 3 answers here, and it's what 2 options are required to build a synthetic long stock position. And I'll look in the chat box for anyone who can answer. Okay, we got a long call and a short put. That is correct. I want to ask you about the relationship of that long call and short put, though. Same strike, same month. Absolutely correct. Both at the same strike price and both with the same expiration date. So that is how you build a long stock position. So the next question is, the position results in a delta of 100, which is like owning 100 shares of the underlying. What happens for every $1 move in the underlying? This is an easy one. Moves $100. That's correct. It actually moves for every $1 in the underlying, the value of the synthetic moves $100 in the same direction. So if you have a long synthetic on SPY, SPY goes up $1, that means you made $100. If SPY goes down $1, then that means the value of that synthetic drops $100. So now the tough one, what is the relationship of the other Greeks? Basically, if I put on a synthetic position, what about my gamma, theta, delta? How do those come into play? They negate each other. Absolutely correct. These are roughly, I mean, they're fractionally, they're not exactly canceled out, but they're so close that it's really not too different, pretty much the same. So now let's talk about a short synthetic position. I'll give you a hint. It's going to be, the answers here are going to be pretty similar. So what options are required to build a short stock, a synthetic short stock position? Short call and long put. That's absolutely correct. And just like the long synthetic, same month, same strike price, and same expiration date. So now, remember, this is the short synthetic. The position results in a delta of negative 100, which is like being short 100 shares of the underlying. So what happens for every $1 move in the underlying? And Britta says negative 100, and that's correct. Basically, it's for every $1 move, the value of the synthetic will move $100 in the opposite direction. So, and then just like with the long synthetics, the relationships of the Greeks are also roughly equal to 0. So what I want to do now is kind of apply that. So let's say I have two long synthetics, one with a $200 strike that expires September 2015. The other is a $186 strike that expires in June of 2015. If the price of the underlying climbs from 201 to 202, this one might be a little bit trickier. Which synthetic is going to make the larger move on that $1 move of the underlying? Nobody? This is actually an easy answer. Okay, in a way, it was kind of a trick question. Exactly, John. It's the same. Both of those are going to increase in value by $1. I'm sorry, $100. Remember, the other Greeks cancel each other out, so they're not even in play. That includes theta, which is time, gamma, which is a derivative of delta, and let's see, theta, gamma, and vega, which is volatility. They're all canceled out. So whatever, it doesn't matter what the strike is, the end result is going to be the same. Now, we're going to take a look at another thing. We're going to talk about a little bit about protection. We've talked about what these are, but what happens if we apply them? So say I've got a short $200 synthetic that expires in 2015 and a long $186 strike that expires in June 2015. I actually have those dates backwards, but the end answer is still the same. So if the price of the underlying climbs from 201 to 202, what is the net effect to my account? Zero. Absolutely correct. So let me fix the dates on those. Before I upload these to everybody, because we want our long to expire we have a short June 200 and a long, oh, that works like that. We'll just leave them the same month. I want to make sure that the slides reflect what I learned a couple of weeks ago. So you can see overall the management of these positions is really kind of pretty straightforward. It's not this is not brain surgery that we're talking about. This is just something that takes a little bit of thought and a little bit of consideration. But once you're in the positions, it's just like playing with the underlying. So that's the neat thing about this strategy, is that you can treat it like a long-term stock buy. You analyze it the same way, do everything the same way. So before I go into the strategy, I want to take a second and just show everyone the mechanics of opening a synthetic position and a couple things to keep an eye on, okay? So this is going to be pretty easy. Let's go share the switch monitors here. Hopefully you can see the paper money account here on the screen. Yes? Good, good, good. Okay. So in order to open a long synthetic, it's this simple. I'm going to right click on the strike price, and I'm going to, I'm looking at the Analyze tab here. Let's just go to the Trade tab. I'm going to start by picking the month I want, and then I'll go to the strike price I want. I select Buy, come down here to Collar Synthetic Combo, and that will give me the order. Now you see the gap here is huge. That's because we're after hours. Usually you're going to see a gap when you go 9 months out of, it's not unusual to see 20, 40 cents, something like that. But after hours, obviously the gap is really large. But once I have this, that's all there is to it. And then I can hit confirm to send. I can adjust my price if I want. But what I want to show you here on the Analyze tab, this is what I want to call up. Let's see, Analyze Buy Trade. This is going to be something that we want to keep in mind is, why is that not showing anything? September 15, 189, I should have a buying power effect. Oh, and it's not doing it. Okay, usually what you'll see is a buying power effect here. I'm not seeing it right now, and I'm not sure why. Maybe it's because it's the weekend. Maybe another upgrade messed things up. I don't know. So I guess I won't show that after all. Anyway, that's really all there is to it. If I wanted to enter put on a short synthetic, change date to break even. Can you change date to break even? Tell me where that is, Marilyn. Change date to break even. I'm not seeing it. Oh, I see. I see what you're saying. Nope, didn't do it. Oh, well. Yeah, it could be paper money after hours. I don't know. Can you see it when you confirm? We can find out. Let's go. Let's see, buy color synthetic. Yeah, it will show you. Even here it says 0. So I'm guessing there's something off with the paper account right now, because I know it will show you that. And obviously to sell, it's just as easy. You can just right click that same, whatever strike and month that you want, come to sell. And again, it's the same thing, collar synthetic combo, and you can adjust your prices and so forth there. So that's the quick way to put on the trade. If you are not using the TOS account, then you would, or if you have another broker, you may have to put on the 2 orders individually as a buy for the call side and a sell for the short for the put, or vice versa. With the wide price difference, do you have to buy when the market is open? Yeah, I always do buy when the market is open. I'm not. I've made the decision the day before, but I actually execute it during the market hours. So those wide price differences narrow quickly when the market's open. That's actually one of the nice things about SPY, and it's something we're going to be going into a little bit later in another session. So I wanted to share those before I start getting through the strategy overview. And so before I go on, anybody have any questions on what we've talked about so far? Just how to buy it, anything else I need to cover before we start jumping in? Nope. Okay. So let's go. All right. So we're going to talk about an overview of the strategy. And as we talk more about this each week, or at each meeting, we're going to dive deeper and deeper and deeper, and hopefully we're going to end up with everybody with a real solid understanding with this. But I'm going to start out with posture and sentiment. Okay, when you're trading this strategy, you need to have a bullish posture for the long side. And for me, I'm generally, and I suspect I'm not too different from most people. I'm more comfortable trading in a bullish market. So that's really where my focus tends to be. So you have to have a bullish posture when you're putting on these orders. And like I say, posture is when you're looking out 9 months or longer. It's very different than sentiment, which is 1 to 3 months. Typically, when we kick off our meetings, we talk about our market sentiment, which is what we're expecting to happen within the next week, 2 weeks, 3 weeks, 4 weeks, something like that. We're talking now about posture, which is more of a longer-term view. We do care about sentiment because that's when we start looking at our protective, when it comes time to start putting on protective positions. So if we can have, sentiment is a lot more dynamic than posture. Obviously, one's looking at long-term, one's short-term. So if you think about it on a chart, this is roughly 10 years of chart on SPY. I think it's about 10 years. So to kind of picture this is your sentiment. This is where, my sentiment, I think it's pulling back for a week. I think it's going to be flat for a period. I think I'm going to have this pullback. But my posture is really where I'm looking long term. So understand the difference of this two. This strategy is really focused, as far as your long entries, on your long-term posture. It's an important thing to keep in mind. So the bullish, when are we going to put on bullish positions? Our long-term, our long synthetic, our bullish synthetic, pardon me, we will only put these on when our 1040 weekly EMA is bullish, okay? When we get a bearish crossover, that's generally when our posture is starting to shift more towards a bearish mode. It's when we're thinking, okay, this is potentially a bigger market, or a bigger pullback than just a short-term swing. It's that's one of the technical type indicators that we use for gauging what our long-term posture is going to be. So we're only going to put these trades on, or these bullish trades on, if the 1040 weekly EMA is bullish. A couple of caveats to adding new positions here is if we have protective positions on, we're not going to add delta to our account, which is essentially what the long position does. By putting on another long, we're going to add delta to our account when we're bullish, by taking off any protective trades that we have in place. And another factor here is, how much buying power should we keep available? We'll be looking to, as long as we're in an uptrend, we don't have any protection on, we're going to look to add new bullish synthetics anytime we can do so and still maintain 10% of our account value in option buying power. Okay. So that means we're going to need to understand a little bit about what the margin requirements are. And I'm going to talk briefly about that. And I'm going to try to give kind of a thumbnail view. It's not going to be the detailed view that I would like, or the detailed description that I'd like to get someone to come in and talk with us about. But it's going to be a good rule of thumb to follow. And lastly, one thing that we also do as a synthetic reaches maturity, let's say, as it starts approaching its end of life, there's going to be two things that we're going to look for as far as when to roll that synthetic out in time. The first thing we're going to look for is probably the most common as we're in these positions, and that's going to be when the short put reaches a delta of 15 or less. Okay, I used to use 20, but 15 I just became a little bit more comfortable with. And what that does is that, because what we're going to do, and when we get into the more detailed discussion of the strategy, we're going to take something and we're going to pick a strike price either at the money or typically still in the money but further out in time. And basically what that's going to let us do is it's going to let us take some profits off the table, basically book some of those profits. Another option that we're going to be looking at as far as when to roll a synthetic is if we start approaching or we're about to enter the expiration month. Now, I mentioned that because we've had this pullback and we have one synthetic position on, I believe it's a December 183 strike. The delta on that did fall below 15 at one point, but it didn't stay there long enough for me to really catch and respond to it. So we still have it now, and delta on that one now is no longer, I think it's closer to 20 or 30 right now. So it is possible that we could get into December and still have that position in place. Well, if that happens, we get into December, then I'm just going to look to roll it out based on time. And so those are going to be the two things that we're going to look for as far as rolling the positions. As far as simply closing long synthetic positions, not generally going to do that unless we turn bearish on the market. So this right here is focusing a lot on the long side, but let's talk a little bit about the protective side. Now, I'm going to talk in detail at a future session on when these protective positions get put on. But if you follow the thread that the discussion thread I've started in our community space, I've been posting every single trade we make to that paper account, our synthetic paper account, basically the evening that after the evening that it's made. So if you want to see step by step, you can follow along with those positions, and I talk a little bit about the rules in there that were followed and the rationale for them. But let's talk a little bit about kind of overall description. Again, we're still in the general strategy mode of those protective strategies. The protective strategies, think of them as insurance. Okay, when you have them in play, you hope you don't need them, but if you do, you're glad that they're there. So I don't mind losing money when I put on a protective position. I don't mind losing money on that protective position. I don't like to get whipsawed in and out of a protective position because then I can lose more than I should. But as far as owning or being in a long position and having protection in place, it's okay with me if that protective position costs me money because I'm still making the same money I was before on the long side. So the net effect on my account is zero. It's if I have a long call and a short put, my account's not moving. To kind of put that in perspective, Thursday I put a message in our Skype chat saying, because I went and looked, I saw that the SPY was down so far for that week, was down roughly $4. Now, if you think in our paper account, we have we have 5 synthetic positions on, 5.5 if you count the $200 September calls that I've closed the short put on. If you multiply that by 500, remember $1 move in the SPY equates to $100 for every synthetic. If we didn't have our protection in place, we would have been down $2,500 roughly. But because we had the protective positions in place, our account was actually up $5 at that time. So the protective positions are good to have when you need them. So like it says here, I normally use short synthetic as protection. And I do have a method that I follow. What I look for is I look for the 1031 MACD, or at any time, I look at it's the same as the difference between the 10-day and the 30-day EMA. I look for a bearish indication there, and that's what I was talking about earlier when I showed the lines on the MACD. They're little crossover lines. If I see us break above a key line, that becomes in my head a support level that I'm looking for. If we start to pull back below it, then I'm starting to look to put on some of those protective strategies. Now, I will say I always leg into these protective strategies, and I also leg out of them. And the reason for that is I mentioned not liking to get whipsawed. I would much rather incorrectly put on half of the protection or a third of the protection that I need, and then have to turn around and take it off, and then turn around and put it back on, than I would to do that with all of the 100% of the protection. Because each time you do that, it does cost a little bit of money. But I found that if I leg into these positions, then it's less risky. I'll just say it that way. I feel I have a little bit more control. I don't always get it perfect, but this way I seem to have better results. And then again, the same thing on the legging outside. If I'm closing protective positions, I don't want to take them all off at once. I prefer to take them off either a half. The way I'll put them on is typically a half, and then the last, or a half, a quarter, and then the last quarter. Generally speaking, I'll use kind of a similar method for taking the protective positions off. Might even go a little bit slower and do it as a third when I'm taking it off. Because again, I'm not necessarily losing overall value in my portfolio by having it on. It's when I take it off, or it's opportunity that's lost. I'll say it that way. So Greg's asking if 1040 cross, if you would just close the trade. If I close the trade on a 1040 cross, I would still leave the short position on, because the short position is still profitable. So if my sentiment changes to bearish, there's no reason to take off. I'm sorry, if my posture starts to change to bearish, then there's no reason to take off my bearish trades. And let's see, do you ever hedge with bear call spreads? I don't, Ed. I have, like with covered, mentioned here, covered calls can be used. Excuse me, covered calls, bear call spreads. I kind of put both of those in the same bucket. They work also. Obviously, the covered call, there's different returns on the two types of strategies. So margin requirements. Again, this is top level discussion on the margin, but there's a couple things that it's important to be aware of. And these are thumbnail views. I'm typically looking at the money strikes when I say these things. So the first thing to understand is the strategies does not require that you use margin, but it does require that you have a marginable account. What I mean by that is we're never going to borrow money to put on this trade. So we're not going to be paying interest on used margin. And that would happen if I had enough money to buy 100 shares of a stock. And if I used margin, I could buy another 50 shares. Well, I would pay interest on the margin that I was using there. Because we will typically get paid to put on a synthetic position, we're not borrowing money to put the trade on. However, we do have to have a certain amount of buying power available. Excuse me, hold on just a second. I need to get a little drink. I'm getting a little hoarse there. So just be aware that the buying power is needed. The margin account is needed. You're not actually going to be using margin, but it affects it's related to the maintenance requirements on the trade. So how do you use that so it's important to understand what the buying power effect is going to be when you put on a position. And roughly, if you look at when we put on a bullish position, we're typically going 9 months out in time, and we're looking at a strike that's roughly at the money, at the money, near the money. And again, we'll dig into that deeper as we get into the details of the strategy. But the margin side of that, basically what that means is you're going to need a buying power that's 25 times the cost of the underlying. I won't say it cannot be done in an IRA account, Ed. Just that an IRA account doesn't have margin, so you have to be cash covered, which in the end really means I'm not sure that the value that this strategy brings to an IRA account. This strategy is using leverage using leverage to grow. So if you have to have the full value of the underlying to cover the position, then why not just buy the underlying and not have the option risk that comes into play, the risk that comes into play with options. There are ways it can be done in an IRA account. I'm not an expert in that, so I'll leave that to you to do a little bit more research, and maybe you can come back and tell us. But I think, for example, one way you could do it is if you have a short put, or if you want to sell a put, you just have to own a put to at a strike price that will, and also longer out in time, that will reduce your margin requirements to the difference. I'm sorry, your holdings requirement to the difference between the two strike prices. We could probably talk more about that offline if you like. It's not something I'm really expert with because I don't trade this in an IRA account. And John's asking, how do you figure out 25 times? Basically experience, John. As I've gone through and I've done some experiments, there's a lot of variables that come into account with the margin requirements. Believe it or not, time actually does have an effect. It's not a huge effect, but there's another piece of that involves the actual price of the underlying versus the strike price. So I use this as a rule of thumb. If you keep in mind that it's 25 times the strike price, you're going to be good. You're going to be good to go. Let's see, and that margin requirement or maintenance requirement is probably a better way to say it, is linked just to the short put side in the bullish synthetic. Yeah, that is a good question, Ed. I don't know. What I'd suggest that you try doing is back testing that. Ed's asking if it's worth it to buy an out of the money put to reduce the margin requirement. And I would say do some analysis. I have not done that analysis, but it should be relatively easy to do. And maybe you could let the rest of us know. So let's see. At the short 189, would you not just have to be able to cover technically, John, yes. If you were trading that in an IRA account, that'd be correct. If you, however, if you're trading this in a margin account, it's not 100 times 189, it's 25 times 189. So I'll give you an example in a second. And lastly, just the short put, we already talked about that last bullet there. So here, let me just toss a couple examples up there. If I put on a bullish synthetic with a $200 strike, my maintenance requirement is going to be about $5,000. Okay, so similarly, if I was to hedge that with a bearish synthetic at 201, that actually ends up reducing my margin, which, Ed, is kind of what you're talking about a little bit. It's a different take on the same thing. So with the long synthetic at 200, I have a long call and a short at 200 and a short call at 201. That doesn't require margin. However, with the $200 short put and a 201 long put, that requires $100 margin. So basically, if I've got this on initial entry, this is my margin requirement to put on that position. Later on, if I'm getting a pullback, I can hedge that with a bearish synthetic that's either the same month or further out in time, and reduce my margin requirement from $5,000 down to $100. And meanwhile, as the underlying pulls back, this bearish synthetic would be the one making the money, and the bullish synthetic would be the one losing the money. And I kind of played around with the numbers a little bit and found that on the bearish synthetic, the margin requirements are very similar. So with a short call, the margin requirement worked out again to roughly 25 times the strike price. Technically, it's probably 20%, but there's some other variables that come into play. I say I use 25 as a guideline, and that's actually been good enough for me. If you wanted to get really specific, that's why I want to get, like I said, that's why I'd like to get someone who understands some of the intricacies of how margin works, especially over time, who can join us. I wonder if Ed's question would be open. You could send. I wonder if Ed's question would be open. You could send to Mr. Oh, would be when you could send Mr. Savnov, is there, the Kings of Delta. I will let Ed do that if he would like to. Oh, that's John. I'm sorry. Yeah, I mean, it could very well be that Mr. Sosnoff knows exactly how to trade this or how this could be managed in a synthetic account. The biggest difference with Sosnoff and a lot of the TOS guys is they are traders, whereas this is an investment strategy. It's not, we're using options to gain leverage, but we're still using it as from an investment perspective. So if you talk to guys, a lot of the guys from the TOS crew about synthetics, they're looking at putting on a synthetic that's a week out, a month out, 6 weeks out. We're going to be looking at 9 months out. So just be aware there's going to be a difference in how they hold that discussion. Let's see. I just did this slide. And that was the summary of the strategy overview that I wanted to share with everyone. I see we are coming right up at 1 o'clock. So a couple of things I'm going to talk about next week is going to be at our next session, which is on November 1st, is I'm going to be talking about which tickers to use. I use SPY. I'll talk about why I use SPY. We'll talk about selecting a strike price, selecting expiration month, and then selecting protective positions, because I know right now that's a lot of interest to everybody. Hopefully by our meeting on November 1st, nobody's interested in the protective positions, but because the market will be taken off like crazy. But we'll talk about that too, because that is a key part of the strategy. I'm just kind of skimming through. So real quick, and Ed, I'm sorry I didn't have better answers for you on the eye review. Again, I just haven't looked at in detail that type of perspective, so I can't. I don't want to I don't want to give you an incorrect answer. So I'm going to just ask you to take a look, do some experiments, and maybe maybe you come back and share with us so that we can have that information for others. All right, good. So does anybody else have any questions? John, would you, shall I pass the ball back to you before we wrap up?